Is the Australian dollar setting up for a 220 pip drop? I think it could be, and I'll show you why in today's video. And we'll also talk about the DXY. Okay, so getting right to it, looking at the Australian dollar daily time frame. So if you saw the last weekly forecast, what we talked about here was that Friday close below 67, okay, 0.67. And the reason that was significant here for this pair is the fact that we had all these highs back here that served as resistance for about 2 months for this pair. We had the breakout above, we had the buy side fake out above that trend line that we talked about back here, which obviously led to a very considerable drop back here toward the range lows and then some. Now, 220 pips, you're looking at this right now saying, well, a move, from this area down here or up here, down here toward 65.80 is certainly not 220 pips. And I'll show you why I think that a 220 pip move could be coming here in a moment. But first, let's talk about 67. Okay, so far what we've seen from this market is a retest of the bottom portion of this resistance area. So again, in recent videos, what we've talked about here was the fact that all those highs from those 2 months that we just talked about, right, from back there in May and June, we have the market now trading back below this. Okay, so support back here, support once again, and Friday close below. Now we're seeing the market retest this area as new resistance. Now, furthermore, what you might notice here, and I talked about this in the weekly forecast, and I'm not a huge advocate of trading head and shoulders patterns on intraday charts just because they do tend to fail quite often. But you can see here that on the Australian dollar 4-hour, what we have is the potential for a head and shoulders. So we had the neckline down here in this area. We got the close below at the end of last week. And so far, again, we're seeing a retest of this area. Now, it's unclear if the high is in or not, right? Obviously, nobody knows that. However, looking at the price action here and also looking at the DXY, we can kind of assume that this area down here is going to be the lower portion of this. And there is still a chance that we see a move above today's high. So, this is not financial advice, but if you're trading this market, and this goes for really any market out there, and this is just my opinion, but if you are trading markets like this, I think it's always a mistake to look for shorts here and get in with a very tight stop loss above this high because you're banking on today's high being the high before a move lower. And a lot of times, especially in sideways markets like this, when we go back to the DXY, we'll look at that in a moment. But the US dollar index has been very sideways. So in a sideways market, when you're trying to do that, chances are you're going to get stopped out before the market can move in your favor. Look, having been a trader for over 20 years, I know how difficult it can be to find a trustworthy broker. And that's why I'm excited to share with you the broker that I've trusted for 7 years now. I've even met them in person. So I would literally trust these guys with my life. And that is Blueberry Markets, where you can trade over 300 instruments in the Forex market, share CFDs, crypto CFDs, commodities, and also indices. Plus, they have 24/7 support, so no more waiting forever for replies. You can get help no matter where you live, and funding your account or withdrawing from your account is super easy and quick with options like MasterCard, Visa, bank transfers, and Skrill. But don't just take my word for it. They serve over 50,000 traders who can use platforms like MT4, MT5, and their web trader, and they have stellar reviews across sites like Trustpilot and Google. So click on the link at the top of this video or see the link in the description. And when you use my link, you are going to get a 30% deposit bonus. So if you deposit $10,000, they're going to give you $3,000 to trade with. With trusted support, hundreds of trading options, and unbeatable reviews, Blueberry Markets is the broker for you. So what I think here is, and again, this is just my opinion, not financial advice, but if you are short in a market like this, the best thing to do is to set your stop loss, give yourself some room here, give the market some room to breathe, right? So don't set a stop loss just above today's high. Give it some room to breathe here in case we do see a move up here into this area, a sweep of today's high before we get more weakness. Okay, so the bottom line is I think that as long as 67, this entire area, is intact as resistance for the Australian dollar, I think that we're looking at a move potentially down here toward the bottom of this candle here, and then potentially down there towards 65.80. Now let's talk about why I have 220 pips in the title today. And that has to do with this area down here. So obviously the range lows down here in this region, right? We've got all these lows back here. We had a sweep of that low, right? Sweep and reclaim and then a rally. And we also have this wick. Now I want to focus on this wick back here from early August because so far this has gone unfilled. In other words, look at what happened following the close here. Okay, this candle closed here. We got a very shallow retrace on the very next day, and then the market took off. So look at all of this wick down here that is completely untouched. And oftentimes what you see with wicks like this is that you get at least a 50% retrace. So looking here at the 50% of this wick, okay, if we take our fibs and look down here at the low, up here to the closing price, okay, so just taking the wick, you can see that the 50% comes in all the way down here, which this, wick on the very next day didn't even come close to that. Okay, so we have this pocket down here that could serve as a magnet. So a lot of times when I'm trading the market, in fact, every time, I'm looking at triggers and magnets, okay, and that might sound a little strange, but bear with me for a second. So the trigger here, in my opinion, was this close back below 67. So even last week, you can see here on the weekly, right, this candle right here closed back below all of these highs. Okay, so this, in my opinion, this close was the trigger for the move lower. Now, what's the magnet? The magnet is imbalances like this down here. Look at this weekly candle. The next week opened and gave a very shallow retrace before moving higher. There's all of this real estate down here that is completely untouched. That means it's an inefficiency, and inefficiencies in the market often act as magnets. Okay, so trigger was the close below here, and the magnet is this inefficiency down here right around 65. Okay, so no guarantees, of course. It doesn't mean it will come to fruition here, but oftentimes you do see areas like this on the daily and weekly charts filled in, okay? So for the Australian dollar, again, what it really comes down to is 67 holding up as resistance on the higher time frames. As long as the market is below this on the daily chart, I do like it lower. The obviously invalidation here would be a close back above this area. If we were to get that, then this entire idea is invalidated. Now, one thing I do want to discuss here before we move on to the DXY is that a lot of people will look at this chart here and see an inverse head and shoulders. Okay, and I'm not saying that it's not, because anything can happen. But this right here is what a lot of people will see. They'll see this over here as the left shoulder, right? We had the move up, the move down, the move up here, and the right shoulder. Okay, so everybody's looking for a move higher, looking at this as an inverse head and shoulders. And it very well could be. I'm not saying that it's not that. However, when you zoom out here, okay, and look at the price action to the left, always look left, you got this price action over here. So this, in my opinion, invalidates it because once you look at this price action over here, right, this no longer starts to look like an inverse head and shoulders. If the market had moved lower and done this, right, and carved the left shoulder and then the head and then the left shoulder, then that would be different, right? And there was nothing over here. But instead, we have all this price action over here that, in my opinion, invalidates this being an inverse head and shoulders. Now, again, I could be wrong, okay? Nothing is saying that this can't move higher. But to me, this is not an inverse head and shoulders. And in fact, when you look at something like the 3-day and just move out here, I mean, this has just been a range-bound market going all the way back to 2023. Okay, so in my opinion, this is just more of the same, right? Range highs up here, range lows down here. So with this close below, again, I do think it looks, relatively bearish as long as 67 holds up. Now, let's take a look at the DXY because this is really the holdout for a lot of these markets right now, with it just sideways and also still trading below 102. Okay, so we've talked about this a lot, but it's still significant when you're talking about the US dollar. So this back here is what we had from the DXY, so moving within this channel. And then we got the breakdown, okay, the failure to climb above 106.5, and we got the failure here. Okay, so notice the bounce right here, and then we got the failure. Now, once this occurred, okay, over here, and we got this breakdown from the DXY within this structure, okay, this is what we're talking about here, then this area up here flips to resistance. And we've seen that here at 101.92. Like I told you guys last week, I mean, this is the same level I've had on my chart now for months at 101.92. And you can see where this was tested last week as resistance. Okay, so this is going to be a resistance area up here starting at 101.92 all the way up to about 102.6 because this diagonal level right here is going to be that channel bottom, okay? So this entire area up here for the DXY is going to be significant. And this is why, again, I think it's a mistake to get too bullish on the US dollar while it's below this area. Really, if the US dollar is going to move significantly higher in the coming weeks and months, we need to see it back above this area. It has to reclaim this area around 102.6. Until that happens, we're looking at a range-bound market here for the DXY with range support coming in down there at 100.6. Now, obviously, we have to entertain the possibility, too, of a move lower for the US dollar. So if that does happen, then we are looking at a break below this area around 100.6 for a move down toward 99.6. And obviously, if we got that, that would invalidate things like the Australian dollar, the idea that we're talking about today. Okay, so this is kind of the holdout for me right now. This is why when you look at something like the Australian dollar, yes, I am relatively bearish while below 67, but I am not overly bearish on the Australian dollar. Same thing with the euro, same thing with the pound, until we see something more from the DXY. So this is really important to consider when you're trading these markets. But again, on the surface, when you look at this from the Australian dollar, this closed below 67, and also this imbalance or inefficiency down here in this area, right? I do think that this calls potentially for a 220 pip drop here over the coming weeks. But again, the DXY is going to be the holdout. We need to see it reclaim 102 and specifically 102.6 to really gain strength here over the coming weeks. Subscribe to the channel and click the bell for notifications. Don't forget to join us in VIP. Claim your 90% off lifetime access. See the link in the description of this video, or if you're on the website, click on that join VIP link. Trade well out there, and I will talk to you again tomorrow.